सो दिस एपिसोड ऑफ द पॉडकास्ट स्पेसिफिकली उन लोगों के लिए है जिनको अपनी स्टॉक मार्केट की जर्नी स्टार्ट करनी है या ऑलरेडी कर रहे हैं बट बहुत फेयरली न्यू है. इन दिस पॉडकास्ट वी हैड विद अस मिस्टर योगेश पांडे, राइट, जिनका कॉर्पोरेट करियर हैज स्पैंड ओवर 30 years एंड उन्होंने अपनी स्टॉक मार्केट की जर्नी शेयर करी है हमारे साथ, वेयर ही हैज शेयर्ड द की इनसाइट्स इनटू हाउ टू डील विद द फियर एंड द ग्रीड इमोशंस ऑफ स्टॉक मार्केट. सो आई होप आप लोग हर बार की तरह इस पॉडकास्ट में भी नोट मेकिंग जरूर करेंगे, पेन पेपर के साथ बैठे एंड डू एंजॉय द पॉडकास्ट. एंड आई वुड वांट, एक बहुत ही दिल से रिक्वेस्ट है, आई वुड वांट एवरीवन टू प्लीज जस्ट show us how much you enjoyed this in the comment section so that we can grow fairly quickly. Thank you. Enjoy the podcast. Good morning, sir.
Good morning, Jayant.
How are you?
I'm absolutely fine.
चलिए बहुत ही बढ़िया. So today we will be talking a lot about stock market, right, and other asset class to some extent. Just give a brief to our viewers, right? Remembering the average age group is 18 to 20.
Right.
Who will be watching this, right? So let me begin with a very simple question, right? What is stock market for you?
Well, stock market for me is a long-term compounding machine.
Okay.
That is how I treat it. It's a wealth builder, but it is a wealth builder only and only if you have a long-term view on the stock market. Though stock market is both about giving time to it, the longer the horizon, better it is. It is also important to time it as well. I don't agree with many of the portfolio manager who come and say you keep on doing safe, you keep on investing each time, every time. There could be some smart entry points also in the market, but overall it is a game of long-term compounding.
Okay.
That's why I always have, let us say, my major holding for long term.
So what is a general framework that you follow before investing in a particular stock? For example, let's say you come across Tata Motors, right? How you come across Tata Motors first, and then how you decide how to enter that in a very brief.
Can I give you a larger brief on this?
Sure.
Before coming to any
Sure.
stock specific discussion?
Done.
So my framework is around three parameters. One is macro, second is fundamental, third is technical. Unless all three are in alignment, my long-term portfolio is not ready. I am not even ready to start that. That is the condition number one. And for macro, it needs lot of wisdom, collaboration with right people, reading books. That habit always helps. You should know history of just not financial market, but everything around finance.
Okay.
Maybe the currency world.
Okay.
And what is happening in currency, even in the modern history, it is important to read at least 700, 800 year old history. We can have a reference of even what happened before Christ also, but it is important to understand the modern history, even that is 700, 800 years old.
Oh.
So I always track currencies and with the geopolitical angle to it, because currency had always been in war, be it Spanish era,
Yes.
when they were the global leaders. Later, it was about Dutch. Then briefly, then it was the Britishers, where the sun never sets, but in set in 1930 finally. Then it was US.
Yes.
And now we are again towards a global reset that is happening. In fact, every 100 years, there is a global reset happening. So to understand those macros is very, very important so that you are in a right place to begin with.
Okay.
So that is the topmost, and it comes with lot of experience, wisdom, collaboration, reading, and this one should do each and every time. You will only improve with time. That is number one. Second could be fundamentals. So even if I am choosing at times something for trading, I make sure that fundamentally it's a good bet.
Okay. Fundamentals of the stock or the
Of
economy?
the sector first,
Okay.
fundamentals of the economy as well,
Hmm.
and then finally the sector and then the stock specific.
So the top-down approach.
So it's a top-down approach.
Okay.
So like there is this saying, no, you never fight against the Fed or the Reserve banks in general. So you always have to look at whether we are in the currency easing cycle or tightening cycles. They definitely impact your performances. And the advantage is if you know those cycles, you look at that, so you don't turn to become despondent just because you are not performing well. You must realize that I am not in a good cycle right now. So my long-term portfolio may consolidate for a moment. It might give you some breakdown also. But then if you know those cycles, that gives you comfort. So macros attached to these broader cycles of economy, they help you in staying firm at your decision, long-term decisions. That is one. Of course, then when we bring it down to the next level, so from satellite, let us say the helicopter view is the sector.
Sector.
And after sector, of course, the stocks within that sector. In stock selection, we have generally two kind of criterias. One is, of course, you have certain parameters which you filter. You out of a universe of 8,000 stocks, you bring down the number of stocks in as per your comfort zone, maybe 200 odd stocks. So you kind of start searching diamond in the dust. So there's so much of dust around. So you come out with few diamonds, but all diamonds may not compound necessarily. So you have to look at their positioning and the sector. Then sector becomes very important, whether the sector is likely to grow. Then within the sector, we also look at scalability. If scalability is not there, even if the company seems to be good as of now, we will, for long term, we will not consider. The business should have that scalability. One criteria. Secondly, of course, when we talk of fundamentals, we look at valuations. In stock market, you earn out of earnings of the companies. Broader, it's always about that. Cycle could be anything. Yes, it could be either you earn too much beyond a point, or you might even not earn anything despite company doing very well. Yes. So it is very important to understand the valuations and where you are. So there are multiple, I'm not going into those fine details of individual parameters, but in fundamentals, what we try to see, we make our filters, we have our systems, screening systems, we come out with the stocks, but then that is not enough. Then within that, we try to see the, let us say, whether in last 5 years, this company has done really very well. Why? Because it has done very well, that's why in our filter. But has the stock performance has outperformed the earning, then perhaps the headroom is not there for expansion. So that is also another important criteria when you enter a stock, that whether there is a headroom or not. So you earn out of two things. First is earning growth of the company. Second is PE re-rating. Price to earning goes up only and only if there is a scope of PE re-rating. So if both matches, it's not that if PE is re-rating candidate is not there, but there is a good profit growth, good top line growth, still we may think of it. But if it comes with PE re-rating, that will be great, because then you compound much faster than the company itself. Company's growth itself. So those are something which you understand. Secondly, we always believe there is markets are considered to be efficient, but at times they are inefficient. And if you can search that inefficiency, that takes a hell lot out of you. But if you can search that inefficiency in the market, you will earn big. For that, you need lot of collaboration. You have to be bit active. You just can't sleep over everything because the bigger money is made not in the structured story but unstructured stories, and suddenly they turn into your favor. We call them bamboo. No, Chinese bamboo is the example, which remains below the earth's surface for 5 years, and then in 90 days, let us say 3 months or so, it becomes a 75, 80, 90 feet long uh, jungle, a high jungle. So that kind of growth. So that turnaround is very much possible, and there are very special situation which comes. So that is something which gives you big money in individual stocks at times.
Okay.
So this is about fundamental side of the story.
Hmm.
Third is technical, which is again very important for me. In technical, uh, we use either the term Brahma, Vishnu, Mahesh. Brahma, the god of creation. So Brahma is something, something is created, but still he is perfecting it. Once he feels that now he has a good product in hand, he hand it over to Vishnu. Vishnu is the person or the god who runs our entire universe. So Vishnu is the momentum. And then during momentum, bad things also happens. Things are not always the same. Parameters changes. So if Vishnu feels that now it is beyond his control again, he might hand it over to Brahma ji. Sir, you please again relook into this and do something about it. Then Brahma ji may do two things. Either he will correct the wrong part of the stock or the company, or he will say it's gone beyond my control. Let us hand it over to Shiva. And Shiva, Tanda starts. So for me, that stage 2 or the momentum stage is the only stage where I do my long-term investing also. The framework is long. So people think long-term investing is all about fundamentals. Find out a good company and put your money over there. But fundamentals are more should be aligned to that momentum also. So our long-term investing is also fundamentals, and if need be, we take exits also, and we re-enter the same stock if needed. So those cycles keep on coming. So our long term is not defined by any time frame as such. If it goes well, we continue with it very, very long also. But if it doesn't go well, we exit. So we do it in a much more sharper way than a portfolio manager per se. Because I feel as a retail investor, if you are a retail investor, you are the most, light-footed person in the world. Uh, Mutual funds, PMS funds, even small cap companies. I mean, small case and other. They are not that light-footed as an individual. You are not questioned by authority that why you are diluted your position, why you are sitting in cash. They may be asked to, and they don't have a mandate to sit beyond a point in cash. So they have to keep on investing. That's why the advice always is, irrespective of the market condition, you keep on putting your money. No portfolio manager comes on the screen and tells you that right now you exit or you don't put your money. I will tell you when the time comes. But he is looking for continuous flow of fund to his fund. So he can't even advise that. So as an individual investor, we have to think beyond even the advice which those suited booted people give. So I follow many technical experts, and Stan Winston is my guru. Stan Winston for technicals, and I follow primary framework is what he has built around 80s, 1980s, and that still works for almost everyone. We redefine it in our way, otherwise mostly that. So this is broadly what I am doing.
Now, just to summarize, but to understand the entire three pillar structure, it starts with understanding the macroeconomic of politics and markets,
Right.
specifically how currencies operate from understanding where the dollar is going, what will be the consequences of BRICS currency if at all it is in the picture near future,
Right.
or how China is turning things around, right? So understanding this is very important
Yes.
for a long-term view on the markets. The second comes the fundamental view, which is a top-down approach of the entire economic fundamentals, the sector fundamentals, and then the stock fundamentals.
Right.
And the third one is the timing and the momentum. That is the technical graph.
Right.
Now, sir, the question is, most of the youth, including myself, I think I entered market looking at the technical part, getting excited by it, right? Because it is a lot seductive, if I can use that word, right? You can see it on the trading view screen, the stock going from here to here. And the YouTube guys are just saying that look at this pattern, this happened. You can track any stock like that and just enter without looking at anything else. Now that is very dangerous. That is what I have experienced. So I think what you said is perfectly that just by looking at the technicals you cannot do. Just by looking at the fundamentals you cannot win. You need to have a thorough view of the entire three structure frame, right? So that you can make actual money, even with being a retail investor, right? Because I have seen retail investors do good in stock markets with this framework, of course, in mind. And just to focus, this is a lot boring for someone who does not like to read, right? The entire process, reading things and looking at the fundamentals, understanding what the sector is. So, for example, if you are talking about hospitality or hotel industry, right, the entire metrics that defines the profitability of hotel industry, if someone sits and understands it, it is too much, too overwhelming. Only for one industry,
Right.
and it is dynamic for every industry. So understanding everything takes time and effort, and that is what one needs to be serious about if they want to enter the stock market and make it. Now the question is, what if someone is not good at this? They do not have that passion of looking at this three pillar structure, and they still want to enter into stock markets. Is there a way, or they should just give their money to portfolio managers, or they should simply enter into mutual funds?
First of all, there is no harm putting it to mutual funds also. But even for deciding which mutual funds at what time, that also needs some knowledge. Because mutual fund cannot change their color overnight. And you must have heard, everybody knows perhaps who are listening to us, the fund which has not performed very well this year might not perform the next cycle.
Sure.
And that is quite obvious. So perhaps even for that also you should have some understanding of what's happening and which thing should work, which sector, whether which market cap will work better. So perhaps even putting money to a fund also require a little bit of awareness. So it's not that you should not. People are ultimately, it is Sensex has moved from what to what. We know all those stories. As 50% CAGR, it is moving up. So ultimately, money will be made in long term. So no doubt about that. But if you want to outperform it a bit, then you should have a strong view also. Otherwise, if you don't want to even study that much, or you want to understand, or you are too busy elsewhere, it is better to hand it over to two things, either a mutual fund owner, and my personal view is you can do something else also. You can put your money in ETFs, index traded funds. The advantage there is the expense ratio is very low. Mutual funds, as you know, their expense ratio could be as high as 1.5%. So they have to perform at least that much extra. And the study says over long term, 85% mutual funds globally have underperformed the benchmark index which they were comparing with. So that means something is wrong there also. So if nothing, there is a Dow theory. If we can go into that detail, very simple. If you can do that and put money in 3-4 different kind of ETFs, it's very simple. You can keep a Nifty 50 ETF.
Yes.
I don't want to be talking very complex things, which I do at times, but it's not necessarily we must do that. You put a Nifty Junior fund, you put a kind of a Nifty 500 fund, let us say, which has a color of all the market caps.
Yes.
And you start doing SIP irrespective of anything else. That is point one. You fix the amount and you do it every month. Second is every decade, at least once, maybe twice or thrice. Nowadays, it has become quite frequent. The market corrects beyond 18%.
Yeah.
Right now, we have fallen around 12, 13, 15% from the peak. So we have a significant fall, and there are certain regions which we all should broadly understand around that. And then finally, the market bottoms out. It is very attractive valuation wise. Now, there you have to put money in three tranches. One, when it seems to be bottoming out exactly somewhere there, but this might fail at times. Put the second trench on the up when it breaks out really from a range, and another trench thereafter. And for those are not the regular SIPs. Bag, borrow, or steal. Put your money into that.
True.
Divert some short-term money. Suppose you have put something in FD. I'm not saying that you permanently exit the FDs and put money in equity, but at times for a year or two period, you can do that also. And most likely your bond and fixed money will not do well in this period. And equity will outperform like anything for short burst. If you put that big amount of money during that time, and you have the as a young person, you have always that dry powder ready with you. Hopefully, then you can put that money. If you do this religiously, and it doesn't require a in-depth knowledge, you can compound around 17 to 18% rate.
Really? Okay.
And you can do your Excels sheet around that. At 15% compounding rate, 2,000 rupees every month deposited in Demat account in those funds. At 60 years, you can be 100 crore plus. So, I do take some classes also for people. And my simple take is invest early, invest for long term. You can compound at a phenomenal rate with few fundamental things. Don't digress from your profession. You must not digress from there. You must be following religiously what you are doing, because your active life, what you are doing is very important. But this will keep on growing up very, very fast in future. And if you follow this principle of Dow theory, once it falls more than 15% or 18%, people have different logics behind that. But then if they stop falling anymore, then you put three trenches, short bursts, and you make big money in 1 or 2 years. That is where you can do 50 to 100% of compounding in a very short period of time.
Sure.
That is where the real wealth is made. But if you keep on doing just those standard SIP without looking at anything, then perhaps your rate of compounding may still be slower, but still not bad.
Okay. So primarily what we can conclude is you can enter in equities, but not direct equities if you don't want to go through that structure of time. And the best thing is to go for ETFs, right? And even if you are going for ETFs, the best way is using the Dow theory. Simply says every time the market falls 15 to 20%, You are doing your regular SIPs in ETFs, that is okay.
Yeah.
But when the market falls 15 to 18%, you put your money in three tranches, which is a lump sum money, right? As much as you can arrange for.
Right.
Right. The possible sources might be FDs or other avenues where you have parked your money.
Yeah.
Right. Now, most of the people are very, as Warren Buffett says, most of the people are fearful when the markets are bottoming out. And instead of putting money, they sit more on cash. Right. Currently, we are in that scenario.
Yeah.
Right. Where the time is to invest money.
Yeah.
Right. And even if the war extends for another month, we can still continue to invest money. Right. If you want to make big in the next 1 year or 1.5 years.
I beg to disagree here.
Okay.
I personally also, when the market is falling, I don't put any money into it.
Okay.
Except maybe some ETFs I might be doing. But unless it bottoms out in my charts and it gives some kind of a up thrust. So there are trend lines. Actually, you don't follow the price, you follow the trend lines.
Okay.
So we draw those trend line in our system. Those trend line should at least, one line is flat, the other line is now started elevating a bit. Then I put my mirror over there. I put a vertical line.
Okay.
I know there was a fall. Now, how my mirror will look, it will look at the upside. So, unless that starts, there is no hurry.
Okay.
If market has fallen 20, 25%, 18, 20%, ultimately, indexes have to go up. In a developing economy, it will be very rare for us to think that as a country, if we are talking of investing in India, we will be underperforming broadly. We are a developing nation. We have demographic dividends in our favor. So broadly, in the 20, 30 years, we should be in good cycle. And these wishes will keep on happening. What is happening right now or during COVID times. So these will keep on happening. But overall, the trajectory in a longer time frame is only positive. So, but generally, when you invest while it's bottoming out, while it's going down, not bottoming out, then the problem is you are catching a falling knife. It might still correct. I have seen stock correcting 90% of their original value in no time. So, same is with the index also. Though the beauty about index is it is very Darwinist, So it always follow Darwin's theory. So it's survival of the fittest is there. Those who are not fit, they will be out of the list. Index. So ultimately, it has a better chance of improving its performance over a period of time. So that way we can do. But apart from SIP in a regular SIP, lump sum I will not put unless I see the first sign of recovery. Okay. And that too I'm very cautious. I will take three tranches as I said. Yeah. So we are a momentum investor even for long term.
Okay.
And for a falling cause, we don't put lump sum money.
Okay. So this was your framework for long term. Yeah. Now, if we go and discuss something that is too much out there and not currently, but it was there, right? We were in a very growth phase of stock market or the bull phase of the stock market.
Right.
Post COVID till I think ending of 2024.
Yeah, September 24.
September 24, we were in a pure bull market. Right. You pick any stock, you put money, and everyone is an investor.
Yes.
Right. Yes. Everyone feels like we can pick and invest and it grow wealth like me. Right. But now, after September 24, people are starting to realize what a bear phase or a starting of a bear phase feels like. Right. Or if not the bear phase, what volatility feels like. Right. So, in this bull phase, a lot of people, especially, got caught up with short-term trading to earn regular income.
Right.
They thought that we can replace our active profession with stock market trading and earn big. Now, what is your view on this specific thought process that using stock market trading for your regular income and leaving your 9 to 5 job or your business and just doing this 9:15 to 3 in 3:13 weeks and just doing this?
So, Jayant, I believe most of the audience which is listening to us today is in the fag end of their education part, and they might enter into job maybe.
Yes. Yes.
And they might start investing big
Hmm.
in the near future. So, my first advice to them
Hmm.
is invest in yourself,
Okay.
uh, in your education, in your learnings, in various skills which are peripheral skills. And I know you are doing a lot of. So those peripheral skill you must work on,
Hmm.
and you must become a good, well educated, learned person in a young age. So that investment will help you in earning a good amount of money through either in a job or in business or any field you choose to.
Hmm.
That is from where the source will come. So I have my own words. I made a theory around, particularly for youth only. I call it a twin tower theory.
Okay.
So the first tower is the active income,
Hmm.
which you do out of your learning, knowledge, habits, and over a time you build. But it is built painfully, one story at a time, then next story,
Hmm.
and you have to put active efforts, money, your time you have to give. So here you are working for money and you are building it solidly. So what height it will achieve depends on your abilities.
Sure.
Second thing about life is frugality. Frugality is not really being conscious. Frugality is all about inexpensive lifestyle. So I will give you a very simple example, and I will ask you to answer it. Suppose I give you a top end Rolls Royce as a gift today with only one condition, free gift,
Hmm.
that you will have to keep it and maintain it for next 15 years, then only you can sell it.
Hmm.
And you, presuming you are a middle class individual,
Hmm.
will you accept my gift or no?
The sheer insurance every year will be out of my budget.
Out of your budget,
Yes.
you might not have a big parking.
Yes.
Whereas cannot be done in a normal parking. So you might have to switch to a society which has a
Very
bigger
looks
parking.
good.
So perhaps this could be too expensive a gift for you. So if we can't, as you rightly said, expect even a expensive gift become too heavy for us to maintain. So why should we do not think of frugality first in life? And frugality we can do. My simple rule is what you earn
Hmm.
as a benchmark, you must save 50% of it gross. Gross earning, gross savings 50%. And that's a benchmark. You can do better than that. And particularly the people whom you are addressing, perhaps, they might even save up to 70, 80, 90% because they are living in their parents' home and there is a joint family.
Hmm.
They don't have to spend, they have to invest only, they have to spend only in their pocket money.
Hmm.
So if you learn frugality here, you save a lot, and even don't try to buy a house for your future. It's too early and it's a bad investment. Putting up your money early for a house. House is a must for your peace of mind,
Hmm.
but it can come later in the life. Those 5 7 years when you are still not married and you don't have kids, you don't have to worry about their education. This is the time when you can invest heavily, and that will give you so much of compounding later when your ability to put lot of money go down maybe with time. So this is the first tower. Second tower comes from frugality is the point. You save a bit, you invest a bit.
Before so we move ahead to second tower, yeah, I have always been a champion of 50% gross savings. Oh, right.
That's it.
But the problem that I face when I tell people, or even my financial literacy course, I tell my students to do this, they feel that this is too unreal. This is too idealistic scenario, right? Because online, what others are saying is 30-20-10 nonsense, right? You invest only 20%, invest 30% in your bonds, and all these things. Now, if I tell a Gen Z to save 50% of what they are earning, I go as long as saying them, okay, save 50% of your pocket money. So at least you have that habit. Now, this feels very revolutionary and idealistic. People say you cannot follow this, right? Although I tell them that I have been doing this since I started earning, right? It's been 12 years now. It has done wonders for me, right? But they don't feel that this is idealistic. So, do you think that frugality or 50% savings can really be achieved in a world where influence buying, right? I see a iPhone with a friend, I buy one, right? If I see a friend going on a trip, I want to go too. Although my 50% logic is not allowing. This is the one thing that how idealistic or how realistic is this? Second, the general question that youth asks me, the students ask me is this कि सर बुढ़ापे में बचा के क्या करें, right? This is the time where we can live. We don't have to spend on kids. We do not have to buy a home. Then why not we just spend it on ourselves and enjoy the life before all those chains of responsibility attach us to the ground? How would you answer these two questions?
So it's very simple. When we say you save with some benchmarks in mind, it's not about really, giving up on your what do you call pleasures.
Yes.
But at times, pleasures are to be defined also.
True.
So pleasure doesn't necessarily come from purchasing something. That's very momentary. A iPhone 16 always challenge you because a iPhone 17 is on way. So not the moment that comes, you are 16, you look like as if
I'm back.
so there is no end to these things. So are there hardly any pleasure? These pleasures disappear very soon. Pleasure of meeting a friend, a nukkad naka chai is far more better in a company. So in life, perhaps pleasure comes from meeting people, being nice to them, meeting good people. You have a family there, friends there. That is where the real pleasure comes, and doesn't require a lot of money to meet them and spend time with them. Pleasure comes from learning and applying something. These are moments of joys in life. Eating out in a good restaurant is only next day morning's acidity it brings. So the pleasure
Definition by the time you sleep.
and I'm not saying entirely you give up on all those things. Some part of it can be there. Secondly, we talk of 50%. If you are investing in your own this thing, you are investing in the stock markets, you are investing in some I don't say entirely put into equity, different asset classes, some bonds which expire with time. So you develop a overall good wealth around that. So perhaps over a period of time, in the ratio, you will be able to spend also more. So it's not that. But looking for very little pleasure, let us look for a larger pleasure around, say, let us say 40s and 50s, not very late age. And that time, the first goal is to achieve the financial freedom.
Very true.
And financial freedom is a simple definition. If your passive income is higher than your running expenses, you achieve the financial freedom. Moksha.
Once you are in moksha,
Nobody can be happier than you. And then you have some freedom of doing what you have passion about. So that passion might cost you something, do that. someone has a passion for a world tour, your targets and goal, you can do better to have targets there also, some goals, and follow them.
In
You
this,
can even put money for those goals, assign the money. Once you achieve that money, come out with that money and enjoy your goal.
true.
No harm.
Matlab, I gave them my own example that I worked for 10 years. Right? I owned, I saved 50% logic, I kept it. Today, I'm pursuing or I'm having my own business around my passion. Now, it is a slow thing. Building a startup, making it profitable, starting the top line even itself is very challenging. But I'm at peace because I have a very big cushion of funds with myself. So that even if my active income is low, come later, I have a peace of mind that I'm not broke. So I also tell people that you can do this. Yeah, you are in a job, then you don't think. Right? A lot of people are. You want to be an entrepreneur. You want to choose a job with less money but more passion. Right? Maybe you're a wildlife photographer, or maybe you are someone who are just by degree someone else, right? But by passion someone else. Now, I think even if you do not have goals like a world tour or buying a big house or buying a big car, everyone has these small passions which we sacrifice because of our active income.
Right.
So I tell people that as soon as you follow this 50% rule, the earlier you will start working on your passions and not care about active income so much, because you will have a wealth to cushion yourself sooner or later, right? So that is also what I think people should know and learn. It is necessary and it is realistic to go 50%, and you don't have to be conjuice, right? You can maintain your lifestyle.
Totally.
You just have to in your head say that you are only earning 50%. If your first check is of 1 lakh rupees a month, you need to tell your brain that you only have 50,000 of your active. Rest 50,000 is not mine. It is for my future self. Right? It is for my kids or maybe my passion or my world tour for that matter. Yes, the second task. From frugality, we build this. Yeah.
So here now you are saving something, putting it there. You have created a foundation. That foundation is capable of building itself. Then you don't have to work there also. For the first hour, you are working hard. For the second hour, it will build itself. And if you do it early and diligently, the second tower might ultimately be bigger than the first tower itself. And that should happen if somebody does this diligently. And that is where, the real pleasure comes when you, even if you are still working actively, you are doing out of sheer passion.
Sheer passion.
Not out of a 5-9 job because I have to earn for my wife and my kids. Not that kind of pressure.
True.
So that is where you improve in your active life also. That nirvana is a must, for being, very efficient and
True.
effective in your career, whatsoever field you are choosing.
Okay. So coming back to the question, looking at stock market as an active source of income. Right? So what is your view? Should people consider, does stock market give you active source of income? That can be your trade.
Unless you are lot of money, you are born with a golden spoon in your mouth, and you have a lot of money in hand. Perhaps because then you have, again, there you have the cushion that if bad phase comes, you don't mind because your input money is really very good. So perhaps it is. But if you are just a middle class person, let us say, building your own career, worried about your own this thing, parent are not there to support you, then it is not advisable to understand it as a full-time career. No, it can't be a full-time career. It has to be a second option only.
Okay. Now you are a strict no. You have a strict no for you. active stock market and making it an active income until and unless you have a cushion of capital. Right? How much should be that cushion if just we want to give the viewers a number because otherwise they'll imagine that even if I have 5 lakh that is enough for cushion. What should be the starting point that if you lose this much you are worried, you're not worried.
So difficult to say, arrive at a figure. But let us say if you are starting with 1 CR as an investment,
Oh,
that's a good question.
okay. So guys, 1 CR if you have, then only think of stock market as an active source of income. Now, people say that with 1 CR of stock, right, I can get same with 20 lakhs of FNO, same leverage. Right? If I
Right,
invest 1
right.
crore in cash, I can do that same amount of stock trading with 20 lakhs in futures and options market.
Right.
And a lot of people are entering into that and bleeding money like anything. Right? So, do you enter into futures and options, or do you teach futures and options, or do you advise people to enter into that?
It's a strict no in our community. Absolutely no. I don't teach. I discourage actively because some people still do. So I even call them up individually and I discourage them because I have seen their process and it's way too behind the kind of people and the things happening over there. You know, if you are good at poker, poker is about reading the other psychology.
Yes.
So perhaps you can be a good FNO trader. But the moment you have capacity, certain capacity to invest in that FNO trade, and the players in the table have 100x capacity. So your intelligence about reading others' card doesn't work because your own face will reflect many things when the bet will go high. So the biggest problem is we are playing teen patti in a table which doesn't fit to our size. That is happening in most of these cases. You know what these of course we don't have those equipment also. We don't have the MLs with us, machine learnings, and they have been far too advanced. Even Indian trader feel that they are handicapped, the big houses, as compared to people like Jane Street and all. They have far more advanced information. So perhaps you are fighting against them. And then, you know, some people say we have also AI generated tool and all that. So suppose you don't have anything to defend. So perhaps you might still surrender. Okay, I will not do FNO. The moment I give you a लकड़ी की तलवार, you say, okay, मैं एक तो लड़ाई लड़ूंगा, Pinocchio type style, you will do something. Windmill से आप fight करना चाहेंगे with your wooden sword. So that will damage you more.
True.
So personally, and why when you have such a good career building, and I tell you, if you are a momentum investor like I am, and if you are perfect to the core, learning stocks individually, putting money at the right point, picking up the inefficiencies in the market, you can generate average CAGR of 25% in long-term investing, along with some positional trades maybe. And they are positional because the long-term investing philosophy failed early, so you exited them. Even if we just do that, 25% CAGR is not granular. Some year it might kind of beating index by 10%.
Correct.
That is very much possible if you are doing it scientifically.
So a big no for futures and options market.
No.
Right? It can be. Again, we understand where the youth is, like why the youth is excited about this because it is a dopamine hitting machine.
Right.
Right. And a lot of misinformation is circulating social media, right? Attend a master class and be a master FXO trader,
Right.
right? And do this, and you will a simple strategy, follow this every day, or simple straddles for that matter. Well, I think for retail traders, straddles fail the most, which seems to be the most easiest way to enter a different market. But again, we need a lot of capital, connection, machines, and people to enter, like Jane Street and the big institutions who can spend that much to generate trades, and even they are spending on the machines, not the humans, to decide
Right.
when to enter into futures and options market, right? Machine, because it is too high emotionally, right? You as a human cannot deal with that much emotions, right? You need a machine to decide for you whether it's time to enter or it's time to exit. And to train that machine, it costs billions of dollars.
Right.
Right? So we need to be very careful. Right? It is a big no, a sheer no. No strategy can help. No technical fundamental chart viewing can help win big in futures and options market until and unless you are a big player with big capital and big technology backing.
Right.
Right? Okay. Now, if someone wants to start learning about stock, the right way discussed, the three structure way, and doing it the right way with the right intent of compounding money in the long run, right? With their active income and active profession in mind, keeping on that in mind, and they want to learn it parallel and build it, right? Not looking this as a short-term trading income, right? Like with the right intent of compounding their wealth in the long run. Where should one start?
Where should one start? You mean how to start?
How to start learning about this?
Learning about it.
Right? Is matlab, should one subscribe to a course or just start by watching this or observing that? Anything. How to start learning about the right framework and starting to use. Before learning, one cannot.
Yeah.
Right. Even for a mutual fund, you said earlier that you need to know basics, right, about the market structures. So, how to start learning about all of this?
So it is good to join some courses,
Okay.
the better of the lot, and just do some research before joining any course. Uh, that will definitely help you build uh, thinking around. Some orientation will happen with that. And the advantage with these courses is that they give you many screens also how to filter things and many ideas across that, and you then can develop your own later. So perhaps that is the simple way of doing it. And of course, I always come to macro. Like you ask a question, I wanted to go into that into detail. That market did very well in certain periods, and then it started underperforming.
Yes.
Normally, there is a short-term mismatch between economy and the markets,
Yeah.
and it always plays like that. For a short term, ultimately, it has to align with the economy. But
Again, those inefficiencies you were talking.
yeah.
Yes.
So, what was happening when globally markets were not doing well? We were doing very well, and our bank, I say never go against the bank. They were tightening the liquidity, increasing the interest rates, and still our markets were booming, which is contrary to. So perhaps when I saw first sign of what we call distribution, like stocks, the stories are being planted, but prices are not going up. Rather, they are consolidating or going down, and then we have certain parameters through our technicals, which gives us a smooth exit. And exit means exit, whether you are at loss or whether you are at profit. So perhaps between September and December, kind of 70 to 80% cash in hand, everything else sold. And charts tell you that also. Apart from fundamentals were very clear, the money is not there, and we have outperformed all emerging markets by a mile. It's not sustainable.
True.
So these things one should be able to read, understand, and they are very good people who can give you a lot of knowledge. But daily looking at TV channels and those trading ideas is not the great thing. Not that they are informing, they are wrong, but their framework is different. Secondly, they are there to tell you something every day. The news anchor TV channel, the business channels, they have to sell everything as a news. So they have to dramatize either side of it. And the problem is, for most of the people which I have seen have entered stocks, they entered through TV channels. And the breaking news is in the TV channel is the end of the news. Actually, it's not breaking; it is the end of the news.
Yes.
Now, perhaps time is to react differently. Whereas when you are a good chart reader, that news comes to you much earlier. It is in the price volume action. It shows you clearly, and if you have certain framework around that, that will also filter out those stocks. And it has happened. Something is happening here. So I always say chart tells you all the news in advance, but in encrypted code. You can't decipher the code. So it's not important to know what is the exact news, but there is some good or bad news around this stock, and the people in the know are already reacting. You better take your position accordingly. So that is where technical helps a lot. So what happened after tightening? Now we are doing very well. We have easing we had done, but then the alpha was so much. It has come to normal 3-4 months back. Unfortunately, now we are with this war around us, crude prices and all happening. So, but it will take time. But sometime post-war, perhaps again, I was talking of back borrow or steal and put money. That opportunity is now knocking the door somewhere around the end of the war.
Correct. We have to be ready with our mirror.
Yeah, with a mirror, things will look like
Cool.
yeah.
Okay. Perfect. I think this is it. Right. Thank you so much, sir, for sharing the knowledge and the wisdom of stock markets and actually telling people what is the right way rather than just selling what is sensational and what fear feeds.
Yeah.
Right. Thank you so much, sir.
My pleasure.